Today's podcast is brought to you by Freetrade, the commission-free investment platform. Head to freetrade.io/pensioncraft and get started today. Welcome to Many Happy Returns, where we aim to make you a better investor. I'm Roman.
And I'm Michael.
You already know you're not supposed to time the market, and yet here you are, hovering over the sell button because everyone's yelling about a bubble. So where's the line between reckless market timing and sensible risk management?
I want to know the least destructive ways to panic. And in today's dumb question of the week, what's the difference between a crash, a correction, and a bear market? All right, let's get into it. So, Roman, sometimes I spend a little bit too much time online, and in the last week or so, in all manner of different places on the internet, I've seen people saying something to the effect of, I really do know I'm not supposed to time the market. Trust me, I know all the data shows it's basically impossible, but still, I'm going to do it. I'm going to sell some of my stocks or whatever it might be. I've even seen it in the pension craft community. Why do you think so many people are going down this mental path right now?
I think there are lots of reasons, and I think the market's performed extremely well. We've seen some unusually high returns, and that's been for not just recent months, but for many years now. And if we look at US valuations, they're very high. We've seen huge concentration risk in just a handful of names. And all of this is making people nervous because they think markets are priced to perfection. Look at my portfolio, it's doing incredibly well. And that inevitably makes people feel nervous. It makes you think this can't last.
So it's kind of a rational fear, right? I think we'd both agree that the chance that we're in a bubble is higher than previously, and the chance of a crash, therefore, is probably higher than you'd typically expect. So it's a rational fear, maybe. But trying to time the market, would you agree, is an irrational response?
Well, certainly in the back tests, if you look at what would have happened if you'd have done this when market conditions were similar, yeah, it's a mistake. Because the thing is about markets is that they carry on rising far beyond the point at which they should based on fundamentals. So even when markets are expensive, they can stay expensive. And in fact, they often do stay expensive because everyone's piling into the same rally. And music keeps on playing and we keep on dancing. That's just human nature.
So I started getting into investing around 2009, actually, after I graduated. Luckily for me, right at the bottom of a bear market. But since then, as the market has rallied and rallied, it seems like every year or every few years, the noise gets louder that this can't continue. And yet it has. If you'd sold out in 2018 because you thought this can't possibly continue, well, you'd be kicking yourself right now.
Yeah, it's interesting. When I first started out Pension Craft, I started creating this kind of portfolio where it was regionally allocated. So I had a bit of Europe, US, Japan, and EM, and I'd kind of move money around based on valuations. But it didn't work. You know, I mean, it was rational to do that. And the US was very expensive at the time. And guess what? The US is still expensive 7 years later. So I think that's the real problem. You think you're being rational. You think you're being clever by moving away from markets which are expensive and moving to markets which are cheap. But it simply doesn't work, certainly over the short term.
But having said all that, some people, regardless of what the numbers show, want to time the market now. Like I said, I've seen people saying, I know I shouldn't do this, but I'm going to do it. Don't try and stop me. So if you are going to time the market, what things do you need to bear in mind? Because it's interesting, isn't it? We talk about rebalancing a lot. That's something you should do probably with your investments. And we talk about trying to match your portfolio to your risk tolerance. Both those things involve selling some things and buying some other things. But that's quite different, isn't it, from market timing?
Yeah, I think what's good about going down that route is that if you are going to reallocate based on some kind of rule, then emotions are taken out of it. And I think emotion is the real enemy here. It's the enemy of your portfolio's returns, because if you allocate based on expectations over the short term, I think markets are going to go down next month. Or I've read somewhere that in February next year, there's going to be a crash. Well, that's a big mistake. But if it's based on a rule, like If my portfolio is 5 percentage points away from my equity target, I will rebalance. Or every year, I will rebalance on this date if my portfolio has moved 5% away from the target. So I think those are the kind of approaches which work very well based on analysis.
So I guess the difference between those two things is that if the trigger is fear, then you're trying to time the market. But if the trigger is, as you say, a pre-written rule, then that's risk management. You know what your optimal allocation is, and you're just bringing it back into line. But I think that is not what people are talking about right now. Even people whose optimal allocation in their mind is 100% equities, say, are saying things like, well, I'm going to sell a load of them.
Now, I think this flushes out one of the difficulties with deciding on your portfolio, i.e. the split between risky assets and safe assets, which is that you can sit in a room, you can take surveys, and this comes out, it kind of spits out an allocation which is suitable for you based on your replies to these surveys. And we've done a whole episode about those questionnaires. But in the heat of battle, in the fog of war, if you like, when there's actually a crash and that red mist descends, well, suddenly all of that stuff goes out of the window and you think, this is my life savings. I've just seen it half. So, what am I going to do? And in that situation, well, that's the wrong time to sell. The time to gauge your risk appetite is before the market's crashed. And I think that's difficult because you have to have gone through one of these awful periods to really see how you feel if markets fall. So what I'd say is go through one of those periods, don't sell, and use that to calibrate your actual portfolio risk tolerance. So you could say, okay, markets fell 40%. I only can stomach, I now know, 20%. So I'm going to cut my risk allocation in half.
Is a rough rule of thumb here, and very, very rough we're talking about, that the maximum drawdown you should be willing to accept is roughly half your equity allocation. So if you're 100% stocks, at some point it's going to fall 50%, probably. If you're 60% stocks, well, you probably need to be comfortable with a 30% drawdown at some point.
Yeah, I think that's a fair rule of thumb because we have seen 50% falls from the previous all-time high. And that's really important to stress because remember, markets trend upwards and we always anchor based on our peak wealth. We never think, oh my goodness, I've made 1,000% since I started. We think, oh no, it's fallen 50% from how rich I was 2 weeks ago. So I think that's important. Realize that you need some risk tolerance in order to win this game, which is to beat inflation.
And I think you're right that now is the time to really think hard about your risk tolerance because the stock market's been on such an amazing run. But again, I want to draw a distinction between market timing and updating your risk tolerance. When we're changing our portfolio to match our new risk tolerance, that's a kind of forever decision. It's not something you're going to change based on market cycles. It's just one decision and you reset your strategic allocation. Whereas market timing is saying, well, I'm going to move away from what I believe to be my correct allocation for some period of time, and then I'll get back into it when things are cheaper. Now that requires two correct decisions and two attempts at market timing, which is, I think, why it's so hard in the first place.
Now, you may think this is a simple thing, right? You just move away from risky assets when they're looking expensive, and then after a crash, you move back in. But in reality, there is no bell that people can ring saying, oh, this is the top of the market or this is the bottom of the market. It is so difficult to actually gauge when things are expensive or cheap. And furthermore, the expensiveness and cheapness gives you almost no information about timing. So that's the mistake that people make. They say, look, markets are expensive, they're very concentrated, and that shows that they're going to fall. Well, no, it doesn't. In fact, it often shows the opposite, which is that we're in a bull market, we're in a bear market, and it's going to continue.
But what if we want to ring the bell, Romin? What if we're determined to time the market? What are the least bad indicators if we were going to do this kind of bad behavior?
So, okay, we've made this distinction between strategic asset allocation, your long-term weights, which you're comfortable with. Now we're talking about the tactical asset allocation and how far you shift temporarily from that strategic allocation. Now, we often talk about the CAPE measure, the cyclically adjusted price to earnings measure from Robert Shiller. Now, that's been a pretty good one historically. Now, it's not good for timing, of course. It only tells you really about the next 5 to 10 years. It tells you almost nothing about the next year. Another one that lots of people look at is the size of the market relative to GDP. And there are problems with that. For example, whose GDP should you measure? Should it be just your country? Should it be global GDP? But however you look at it, the US is also expensive by that measure. Another one that's used, which is a bit more sophisticated and also a bit more subjective, is the equity risk premium. That's how much you expect markets to generate. So for equity, it would be the equity risk premium. How much would it generate above risk-free rates? So, for example, it could be how much the US equity market generates above the 10-year Treasury rate. And there are various ways of estimating that, but it's all based on cash flow projections, which, as I say, are subjective. They're just a guess.
So all those things you've just mentioned, the CAPE ratio, market cap to GDP, even equity risk premium, I would sort of group those things all up as valuation metrics. They're trying to say, is the market expensive relative to its historical average? And like you said, most of these metrics are kind of good in a way at saying, will the next 10 years return be above or below the average return for stocks that we've seen in the past? But they're not good at timing, really, are they? It's not like you can say CAPE's high, therefore I sell and wait for CAPE to fall.
No, and a lot is to do with our lifetimes and our lifespan, which is 80, 90 years, which is only 8 or 9 decades. So it's very difficult to sit tight for, 1/8 of your lifetime in the hope that this guy, this Nobel Prize winner, Robert Shiller, is going to be right. That's the difficulty. And we live day to day, right? We look at our portfolios day to day, and that's the way we think, and that's the way we perceive the world. And that's the fundamental problem here. We've got a valuation metric that works over a decade, and we have to live through every day in that decade and have faith that valuation is going to work.
And even if you knew that the CAPE measure was going to be predictive over a 10-year time frame, say, right now it's expensive, and you think, okay, returns are going to be low, it doesn't tell you the path that returns take. Like maybe they'll rally really hard for the next 9 years and then have a crash at the end. Or maybe we'll have a crash right now and then rally really hard. Or maybe they'll just creep up by 3% every year for the next decade. You don't know.
And sometimes CAPE is wrong. Sometimes markets start off a decade expensive and they're expensive at the end of it. Or they start off cheap at the beginning and they end up cheap. So don't put too much faith into valuation. But there are lots of other indicators that people look at. And as a strategist, these were the ones we often trotted out. For example, if you look at the yield curve, which nobody understands, this is the shape of borrowing costs for the government from 0 years up to 20, 30, 40, 50 years. Now, normally what happens is you get paid more to lend to the government over a longer period of time than a shorter period of time, which means that the yield curve is upward sloping.
Which makes sense, right? If I'm going to lock my money away for 20 years, I want more in terms of a yield than if I'm going to just lend it for 1 year.
But then when things go wrong, you get this inversion of the yield curve, where the central bank has raised interest rates or the long end of the curve's moved down, and that's because of low growth expectations. So this yield curve inversion is usually a fairly good indicator of whether there's going to be a recession. And a recession usually means a bad environment for equity. So often this works, but not always. There was a recent really bad fail for the yield curve inversion.
Yeah, I look at the yield curve and I think, okay, when it inverts, it's kind of saying a recession-ish thing is probably coming sometime. It's not going to tell you sell everything now, usually.
And this time around, it predicted the pandemic, which...
Yeah.
Which just shows you that it predicts nothing, right?
It's omniscient, Roman. That's what it is.
So yield curve inversion is one of these kind of macroeconomic measures. Another one might be purchasing manager indices. And if you go to S&P Global on their website, if you Google for PMI, you'll see the latest publications. And they're pretty useful. They do tell you what companies are saying, whether orders are increasing, whether things are looking more optimistic, whether they're hiring. All of this stuff feeds into the overall picture that you can see for markets if you're a strategist. PMI indices are really important.
They're quite a good leading indicator for inflation as well, aren't they? Because you can see what the prices are at the factory gate.
Yep, and also GDP. Because, of course, business activity feeds into gross domestic product.
And PMIs are, again, one of those things that sometimes are a remarkably good leading indicator. Like if you were trying to time the bottom in 2009, the PMIs called it, right? They turned at the same time that the equity market turned upwards.
Yeah, sometimes they're spot on. Sometimes, again, you can get a false signal. So again, focusing on just one indicator is a mistake. Another one might be credit spreads, because remember that credit strategists are the most miserable people on earth. They're always expecting the next disaster, and sometimes they're right. But if you look at credit spreads, which is the additional income you receive for taking credit risk in markets, when that widens, it often tells you that equity markets are going to sell off too. Remember, equity strategists are always the jolly ones. They always think everything's fine. The sun's always shining if you're in the equity market.
I would love it if that was a reliable indicator, though. If equity markets kind of worked on a lag from credit markets and you go, oh, there goes the credit spread, time to sell my stocks. But unfortunately, that doesn't seem to work either.
No, again, it's not a reliable indicator. Often it's the case that crises are caused by problems in the credit market, which is why it's always a good idea to keep an eye on that market and spreads.
People are talking about it right now, aren't they?
Yes, indeed. So we've seen the default of First Brands, and there have been some other big defaults in the United States. So, yeah, maybe this is another credit problem brewing.
People are talking about underwriting standards again, which is the sort of scary phrase I never like to hear.
So all of these are based on macroeconomic indicators, which I think are quite useful and easily found in free resources that you can find online. Another thing which a lot of people look at is the market itself. So the thinking here is the signal is in the price. So for example, people look at these technical indicators. Now I've got to say before we start this, I'm not a big fan of this, but the idea is you'd look at the 200-day moving average of the stock price and is it above or below the shorter term moving average? And there are all sorts of indicators based on these moving averages.
To me, this kind of thing is almost an acknowledgement, really, of what you said earlier, that markets can stay irrationally high or irrationally low longer than you expect. The trend is extremely powerful. Let's just follow the trend, right?
And there are whole funds dedicated to this, momentum funds, where they buy the stuff that's going up and they sell the stuff which is going down, which works surprisingly well.
But does it work for the market as a whole? Can you time it by saying, oh, the trend's changed, therefore I'm going to change my allocation?
Well, actually, this is one of the factors that people have looked at in a lot of detail, and it does seem to work pretty well. Of course, the times when it doesn't work is when the trend ends. Now, that's a real problem, of course, because the timing of these funds is usually based on a fixed schedule, certainly the passive ones. So if in that 6-month period, when it rebalances, it doesn't time it quite right, you can really get hurt.
But all this stuff about the 200-day moving average or whatever is trying to identify the point at which the trend changes, right? That's what it's trying to do. So that's the bit that's unreliable.
And the trade-off here is look-back period. If it's too short, you'll be trading in and out of the market continually. If it's too long, then you'll react too slowly. So there is a kind of sweet spot, but yeah, I've run optimizers for this, and everyone has, of course, if they play around with markets, and there is no secret sauce. So again, I really wouldn't depend on this as an all-seeing indicator or something which is going to avoid you making losses, because it won't.
So we've basically covered 3 different buckets of indicators people might look at. There's all the stuff around valuation. Then there's the stuff around macro and leading indicators. And finally, we've had this kind of trend following stuff. I'd say there's a final bucket of indicators people look at. And these are the ones I often see referenced in analyst reports out of the investment banks, which are things like market breadth and concentration, maybe even the percentage of stocks in an index that are above their own moving average over a certain period of time. And typically, if you read a report from someone like Goldman Sachs, it will pull together a lot of these different indicators around how the market is constructed right now compared to its past. And then it'll usually hedge the outcome by saying, oh, maybe we're in a bubble, maybe we're not. Who knows? The recent report from Goldman actually said, we're not in a bubble yet.
Yeah, right.
Did you see that?
I didn't see that.
But it referenced all these kind of things about breadth and concentration and compared everything to the dot-com bubble. And from what I saw on the graphs, it was saying, yeah, this isn't as bad as the dot-com bubble. But then when you looked back on the measures over the last 50 years, it was like we're a little bit below the dot-com bubble in terms of valuation, whatever. But we're above every other time.
Yeah, remember these guys have got to be trotted out in front of the equity trading floor. And if they're saying your asset class is doomed, they're not going to get put in front of clients. So there's always a kind of vested interest here.
But what do you think about all these kind of indicators that go into those reports? I'd almost class them as health warnings for the market.
Yeah, I think it's interesting to monitor them. And I think some of them work better than others. Every strategist has their own favourites. I remember for a while, one of the really popular ones was credit impulse, which is how much additional money is being pumped into the economy. Now, for China, that was a pretty good predictor of what was going to happen to markets in China. But all of these indicators wax and wane in terms of popularity. Sometimes they work, sometimes they don't. The way I think of it is kind of like a dashboard where you can see various bits of the economy, the markets, and see where the stress is in the system. Kind of like a steam engine where, you can see that this pipe is now leaking, we've got to fix it, and that's a problem.
But even if you built this dashboard, right, with all these different indicators we talked to, and we know that they all work sometimes, you never know which one to look at in the current cycle. I guess you could say, if the dashboard is flashing red in enough places, then the chance of a major market crash is higher now than at other times. But that's probably all you can say, right? It's just a probability-based thing.
Yeah, remember that equity markets are always optimistic. Even if a lot of the indicators are flashing red in credit and elsewhere, they'll carry on rallying. But to sum up all of these indicators, I think all of them tell a partial story about what's going on. It's certainly worth monitoring them and being aware of them. And incidentally, if you get our weekly newsletter, we will be talking about all of these indicators when they flash red. But don't rely on any single indicator and don't think that these will allow you to time the markets correctly, because they won't.
But that doesn't stop people trying. And after the break, we'll talk about, if you are going to try, what's the least destructive way to implement a bit of naughty market timing?
This episode is sponsored by Freetrade. Right now, you can get 2% cash back when you transfer £10,000 or more in pensions to Freetrade. Switch to one of the UK's cheapest SIPP providers. With a Freetrade pension, there's just one flat fee, zero commission, and access to over 6,500 stocks, bonds, and funds, all in one easy-to-use investing app. Visit freetrade.io/pensioncraft to start your transfer. Capital at risk. Other charges may apply. SIPP eligibility rules and terms and conditions apply. Cashback is capped at £1,000 per customer and the offer ends 31st of December 2025.
Okay, so we've talked a lot about the things that make people nervous when they look at the market. So what do you do if you've decided that, well, I know I shouldn't, but now's the time. I'm going to sell some stuff and change my asset allocation. I'm going to time the market. What do you need to think about there?
I think humility is important here. And I think understanding that you might be wrong is a useful way of approaching it. Now, if you're absolutely certain markets were going to fall tomorrow, well, of course, you'd sell everything. But if you're not sure, then you'd sell a bit less. So use that uncertainty in your favour and just don't do anything too drastic. I see people talking about selling all of their equities, or I speak to people who have sold all of their equities. And I try not to look appalled, but of course I am appalled because that's an awful thing to do. Because then you've got the awful problem of getting back into a rising market often where you just feel like an idiot and you have to just take a loss effectively because you have missed out on those gains while you've been out of the market. So all I'd say is don't do anything too drastic.
So are you thinking more that, let's say I'm 100% stocks, that's my actual asset allocation, that rather than going to 0% stocks because I'm nervous, I dial it down a bit to like 80-20 or 60-40 maybe?
Yeah, maybe follow what fund managers do, which is to say, look, these are our strategic asset allocations. 60-40 is my average, and I'm only going to deviate by 5% from those long-term strategic weights. So my tactical tilt will be quite small, and agree those rules up front. It's really tempting in these kind of markets to say, I'm going to break the rules because I just know it. I feel it. It's in my waters, as Laura says.
Yeah.
But I think that's a mistake. I think having these rules in place really will help you longer term.
And there are funds that actually do that, don't they? They have dynamic asset allocation based on various indicators. I know Vanguard runs such a strategy. But what I think you basically need to find, if you're determined to go down this route, is a way to kind of indulge your fear without wrecking your portfolio. So as you say, keep it small. That might be by just tweaking up or down by 5 or 10%. But another way might be you say to yourself, no, I don't touch my portfolio. I never touch that. That's my core allocation. It stays, rain or shine. But what I am going to do is withhold new money from the market. So I stop my monthly contribution into my index fund for a period of time. Now, I'm not saying that's an optimal thing to do, but it's a way to express that fear without going overboard.
Again, I'd be cautious about that because you may lose track of how much money has been de-risked. So another way of approaching this is to keep your eye on the percentages. And again, do this fun versus core split, the satellite core approach. So currently my fund portfolio, which is about 10-12% of my overall assets, half of it, in fact, a bit more than half of it is in cash. So that's where I've done my tilt. And I think that's important. Have those limits and make them percentage limits because the percentages are what determine your returns, not the absolute amounts.
So I know, Roman, that you're a cautious investor. You always say that. But you've managed somehow psychologically to make your core portfolio aggressive and have expressed your fear in your fund portfolio. It's an unusual way around, but it works for you.
The point is, I guess, about fun is it's market timing, it's all the toxic stuff, it's about learning. And if you do want to have a tilt, it really restricts the size of that tilt. So if I thought something was a great opportunity like copper or perhaps UK small caps, I can indulge that whim without destroying the returns of the core. And if that whim is de-risking, then that's where it goes. And I know it sounds weird that the fund should be cash, but maybe fun is the wrong word. Maybe trying to beat the market would be a better way of thinking about it.
So if we're thinking about the least bad ways of timing the market, keep it small, keep it rules-based, and keep it temporary, I'd say. You've got to acknowledge to yourself on day one that you do this, that at some point I need to get back to my proper asset allocation, provided you understand your own risk tolerance and you know what your asset allocation should be. But right at the top of this section, you said you've got to be humble. You've got to know that you could be wrong. So what do you do if markets keep rising? You've sold a load of your stock, and now the market rips up another 20% while you're half out or fully out. This is a thing I think a lot of people don't put enough thought into before they try to time the market.
And again, I think it's a matter of humility. Always allow yourself to change your mind. Don't be stuck in this rut of thinking that you know stuff, because being in markets any length of time will show you that you know nothing. And really, humility is the most important asset of any kind of investor nowadays, or ever. So look at what's happening in markets. If you can see that you're wrong and that your analysis or whoever you were listening to was just wrong, well, be willing to admit that and concede it and get back into the market.
You say that like it's so easy, Roman. But think about this. Imagine you've sold all your stocks or half your stocks because you're pretty sure a crash is coming. Things look expensive. But then the market goes up 5%. You think, okay, bigger crash is coming now. Then it goes up 10%. You think, wow, this is going to be a hell of a crash when it comes. Now it's up 20% since you sold. every little bit it rises psychologically makes it even harder for you to get back in, don't you think?
That's definitely true. So that's why I think it's so important just to know these defaults, which is that equity markets go up. That's the default. If you withhold money from the market, you'll almost always be wrong. So that's really important to know. And just because equity markets are at an all-time high, again, that's a situation which is incredibly common. People always tell me this. They always say, oh, look, markets are at an all-time high. But that's the default condition for a market which is trending upwards on average over time.
I was thinking earlier today, how would I actually do this if I went down this route and I was selling my stocks? And I wondered, would you have to put in place and pre-commit to a re-entry rule before you sell anything? Sort of say to yourself, I believe a crash is coming, therefore I'm exiting the market for the time being. However, I could be wrong, and therefore I've got this rule. I don't know what that rule might be. Maybe it's, okay, we'll look at the technical moving averages again, and if the market closes 2 consecutive months above its 200-day moving average or whatever, I'm going back in. Or maybe even something really simple that if there hasn't been a crash in the next 6 months, I'm putting half my money back in. And if there hasn't been a crash in the next 12 months, I'm putting all my money back in. Sort of say to yourself, this trade is time limited.
I think that's a healthy approach because it encourages you to do the right thing, which is never to withhold money from the equity market, for your equity allocation at least. So that's the situation where you're locked out of the market by being wrong about a crash. What if you're right and markets actually do crash?
Happy days!
Well, you'd have thought so, but then you're faced with this situation where you're bombarded with all this negative news flow about how awful everything is and how equities are a terrible investment and this is the end of the financial system. And yet you've got to get into the market again and you've got to run into that burning building and allocate. Now that's incredibly difficult. And it's particularly difficult because when you're actually in the heat of battle, you can see markets falling every day. And it feels as if that'll never stop. But in fact, it will. Of course it will. But when do you get back in? Will it fall further in future or should I allocate capital now? That's the question in your mind.
To go back to your steam engine analogy, it does feel like shoveling cash into the furnace when you're investing during a falling market.
And I was quite proud of myself. You know, I've got this stuff in my fund portfolio, my small cap UK portfolio, my copper portfolio. When it was looking catastrophic and it was just falling, I did put money into it and it did turn around for both of those. So I was quite pleased that I did that. I thought I should just mention that.
Yeah, you got to sing your praises when you get things right.
It does happen occasionally.
I was listening back to one of our old episodes, Roman. I think it was back in March or April. And I said, my top pick is Google. Just say Google's up 100% since then. It's doubled. Anyway, moving on.
michaelstocktips.com.
Yeah, don't listen to me. But anyway, going back to this problem, this nice problem of what if you're right, I think the first thing to acknowledge to yourself is you're not going to pick the bottom. It's not going to be the fact that you can withhold cash, wait till markets fall and go, oh, this is the moment. The good news has come. I'm going all in again. That's basically impossible because stocks tend to rally before the good news arrives.
And it often goes in fits and starts. So there could be a huge rally and that would be followed by another large fall. And if we look at 2008, you can see that happen repeatedly. So just as you expected the dawn to break, there'd be another catastrophe, another piece of bad news which pushed markets even lower. But the important thing to remember is if you are globally diversified, then equity markets globally don't go to zero. In the kind of environment in which they would, we'd all be dead anyway.
Or living in a post-capitalist utopia. Come on, some optimism.
Yeah, that would be optimistic. But here, these mean reverting measures like price to earnings multiples and price to book value, all of these valuation measures become really valuable because there you can say, well, I can see that markets were expensive, but where are we relative to the long-term average? So, for example, if we get to a 15 times price to earnings multiple for the US, well, that's cheap. That's an absolute measure of cheapness. And so that, I think, would be a very attractive entry point.
Yeah, I don't like all this discussion about attractive entry points, though. I think most people who do this probably have to say, once the market has fallen 10% from its all-time high, then I just start drip feeding. Money every month is going back in until I reach my allocation. Otherwise, you're always going to be waiting for a better entry point, and you might only get 25% of your money in before the bull market resumes.
There is research that shows that that's not a good way of doing it. Valuation's a better way of gauging when to put money into the market. And it's widely available. Almost all of this stuff you can get for free somewhere.
But what if you're just waiting for it to get down to a 15 times multiple, but it doesn't? It gets down to a 16 times multiple, and then we rally back to all-time highs. Well, you're sitting out again, and the upward drift has resumed.
Yeah, if you anchor on a specific number, I think that's a mistake. But importantly, you should be allocating money once you reach a reasonable multiple, I think. Don't go all in. I'm not saying there's a line in the sand for multiples where you should just say, I'll put everything back in.
But don't you think if people are doing this bad behavior, we should be encouraging them to kind of, as quick as possible, get back to the good behavior of being in their optimal asset allocation?
Yeah, what I would warn against is a 5% fall making you freak out, because sometimes I see that. I see the comments on YouTube where people say, oh my goodness, the market's fallen 5%. Well, that happens on average every couple of months. So that would be a crazy signal. So always calibrate these things so that you can say, okay, it's often the case that we get this size fall, but this size fall really is significant. And that's why I came up with this 2, 6, 16 thing. So just to recap how that thing works, a 30% or greater fall over a 1-year horizon happens 2% of the time. So it's very unlikely. A 20% or greater fall over a 1-year horizon happens 6% of the time. And a 10% or greater fall over a 1-year horizon happens 16% of the time. So that's a fairly bog standard occurrence, and it shouldn't make you panic. 10% sounds like a lot and it feels like a lot, but it's very common, which means that what happens after that is that markets snap back up. So use that rule just to calibrate your expectations. So 10% fall, not a big deal. 20%, interesting. Why did that happen? 30%, oh my goodness.
But the point remains, as the market's falling, you don't know which of those falls you're in. Is it a big one? Is it a small one? And I think, to sum up my feelings about this, if you sell based on vibes, but plan to buy when you feel there's certainty, you will never buy stocks.
Yeah, there'll always be uncertainty. There'll always be bad news flow. There'll always be reasons not to get back in. And they often sound clever. People who are bears get a lot of airtime because people love misery. Optimists sound like idiots during a crash, but in fact, they're the ones who you should be listening to.
I sometimes feel, Roman, that we're a bit weird because if you look at our portfolios, we're optimists, we're aggressively into stocks. But if you look at what we say, we're kind of quite bearish. I guess that's the nature of being a commentator.
I'm not sure that I'm bearish. I think that equity markets are a good way to invest. It's taken me a long time to come around to that because my background was in fixed income.
But I mean, I've heard you mention the current situation as a bubble many times, rather than saying, oh, this is a new normal. Wow, we're into a tech utopia very soon.
Oh, yeah. I think that that's true. But the key point there is, what should I do about it? And the answer is often nothing.
Keep making crash videos on YouTube, Roman. That's the answer. Anyway, just to wrap this up, I wanted to say, why do you think so many people get sucked into playing this game? Even people who know that the odds are heavily stacked against them. Why is market timing so seductive?
I think all of us feel as if we have some kind of intuition about markets because we're players. We live in this world. We sense things about the market, we get the vibes, and we feel as if we have some kind of insight, even if we don't.
So that's kind of overconfidence then?
Yeah, and I think there's a behavioural bias here because we're more scared of loss than we like gains. So the reason why we have this asymmetry, why we're talking about selling because of a market crash rather than buying into rallies or having too much risk in your portfolio, is because of this risk aversion.
I also feel that a lot of people have a kind of action bias. I think is the term from psychology, where doing something feels a lot smarter than just waiting. Whereas in fact, it's the patient investor that tends to profit over the long term.
And in fact, for the members, I recently made an explainer. They vote on these questions, so I know they're kind of relevant to people's psychology at any point in time. Someone asked a question about selling. So the name of the explainer was Why Selling Feels Clever But Costs You. And there was a lot of feedback from people saying this is exactly the message I wanted to hear right now. Because it does feel clever. It feels as if you're actively doing something to preserve your wealth rather than just passively sitting there and hoping for the best, which is actually what works much better in the long run.
And the trouble with market timing is that really there's only one bullet in the chamber. Once you decide to sell a big chunk of your stocks, that's probably the only bite of the cherry in terms of market timing you're going to get over the next decade. And you have to get it right first time. You can't keep predicting a crash and then go, oops, I was wrong, let's get back in. Oh, I know, I've missed, 10, 20% return in that time. That's a quick way to decimate the return of your portfolio.
And that's the most important message. If I do one-to-ones with clients, it's really important to get that across, that if you do de-risk, it's almost always not going to work. And if you stay de-risked, well, you're sacrificing return. So understanding cash drag is really important.
And on that note, I feel like, Roman, we might have jinxed this whole thing and we're all going to stick to our allocations and it's going to start crashing next week. Don't you think? We've been too, disciplined here.
Now, I mentioned the explainers that I do for our members. You get to vote on those, so you'd have a say in the videos I make for members. And these are members-only videos, and we have now over 300 of them, which I've made over the last 6 or 7 years. So if you want to become a member, just go to our website, pensioncraft.com/membership to learn more.
Okay, today's dumb question of the week. What's the difference between a crash, a correction, and a bear market?
So I think of this as the taxonomy of fear. We're talking about how markets react to bad news and labeling the reactions. So let's take it in order of the size of the sell-off. The smallest one is a 10% move, a correction. That happens very frequently. Then we get to a bear market, which is a 20% fall from the previous all-time high. And then a crash, some people say it's 30% or more. Some people say it's about the speed of the fall. But the important thing to remember is you never know when you're going from one to the other. If we have a correction, will it turn into a bear market? Will it turn into a crash? You don't know.
I saw a stat that if you look at the S&P 500 and go back to 1975, there have been 27 market corrections since then, i.e. a fall of between 10 and 20%. But of those 27 market corrections, only 6 of them have turned into bear markets, where they go beyond a 20% fall.
So very unusual. And the normal reaction is for markets to snap back to where they were previously, usually fairly quickly.
Certainly in recent years, it seems that when we've got a market correction or a crash, it's been a sharp down and a sharp up, a kind of V shape, hasn't it? Especially that COVID one, where I think it was a bear market, but it lasted, I think, less than a month. It was the shortest one ever. Now, that's done a few things. One, it's conditioned investors into this kind of buy the dip mentality. Like, you better act quick because this sell-off isn't going to last long. But maybe it should reinforce in our minds that market timing is difficult because you've got to be right twice. And it's even more difficult when the bounce off the bottom is extremely quick. Because if you miss those first couple of days of the rebound, you might have missed out on, 10% plus of gains.
And that's why I think grounding yourself in the actual stats of markets is something which is very helpful. I know that for flying, the thing that stopped me being scared of flying was just looking at the stats. What's the probability of a crash? It's very low. And for me, that was enough to get me back on aeroplanes. So if this is what it takes to get you back into markets, then pay attention to the stats.
I bet you're still gripping the armrest really tightly in takeoff though, Roman.
Actually, no, I'm quite a relaxed flyer nowadays.
Thank you for joining us for Many Happy Returns. Keep sending us your questions, no matter how dumb, at mhr@pensioncraft.com.
And do remember to check out pensioncraft.com for all the information about our membership, courses, and investment coaching options.
Many Happy Returns is a PensionCraft production, co-hosted and executive produced by Roman Nakiza and Michael Pugh. This podcast is for informational and entertainment purposes and is not financial advice. We do not provide recommendations or endorse any decision to buy, sell, or hold any security. We cannot be held responsible for any actions listeners may take, and investors are encouraged to seek independent financial advice.